Welcome back to the Till, Truth in Lending and in Life. If you're new to my channel, my name is Kevin Retcher, owner of First Meridian Mortgage, and today's video is a very important video if you live here in Northern Virginia and you're thinking about buying a condo, if you own a condo, if you're on a condo association, if you have a family member thinking of downsizing, a parent downsizing into a condo association, there is some big news from Fannie Mae today in this video. I'm also going to break down what happened with the Fed this week and the effects on interest rates, and also touch on the Iran war and interest rates in this video. So let's get into it. The big news of the week, the Fed essentially leaving interest rates the same. They are in a hold pattern for an extended period of time. And the Federal Reserve met on Wednesday, 2 days ago, had an 11-1 vote to hold interest rates steady at that 3.5 to 3.75. Chairman Powell actually said, and I'm quoting, "The implications of developments in the Middle East for the U.S. economy are uncertain." That is a Fed's diplomatic way of saying the Iran war threw a wrench right into everything, right? And the situation for the Fed is a tricky one. One on hand, we have jobs have slowed, the labor market softening, which means potentially rate cuts. On the other hand, you have oil prices spiked because of Iran conflict, and that's pushing up inflation, which normally means rates on hold or even a rate rise. Powell said himself the risk to their dual mandate is leaning toward the labor side, meaning might need to lower rates, but the upside to inflation, meaning with the oil prices, might mean that he can't cut. So a number of the key economic reports, the PCE, they bumped that up, and they bumped up their inflation numbers. So on top of that, wholesale price, producer price index surged 0.7%, biggest jump in a year. Food prices up 2.4%. One of the biggest things that I've heard is, while we were all supposed to be getting larger tax refunds, that the Iran war has pretty much mitigated the benefit of those tax refunds by all of us paying higher oil prices. So when we look at the CME chart here for what they're predicting, 3.5%, they essentially do not have a rate cut on the books until April of 2027. What I do want to push out there is they have increased the chances of a rate increase in October to 21%. So that actually has risen as a potential situation. If the Iran war goes longer than expected and inflation gets pushed up, they could have to slow down the economy by raising interest rates. So the next thing I want to discuss is a huge scenario or a huge situation with condos. And everyone that is in a condo, thinking about buying a condo, thinking about downsizing to a condo, needs to truly understand what's going on from the Fannie Mae perspective. And keep in mind, Fannie and Freddie kind of usually align. Then you have FHA and VA that have different rules, but keep in mind they're all regulated by FHFA right now. And if one entity is doing this, the others may fall in line. Now, benefit with the VA loan is if it's already been approved in many cases, they, unless they have a new guideline and have everyone update things, the VAs may continue to go smoothly. But these new Fannie Mae rules are going to be huge. So I want you to pay close attention if you're a realtor thinking of buying, downsizing, if you own a condo, if you're an investor in condo. All these things are going to come into play. March 18th, Fannie Mae dropped a new letter, and the significance of this is huge. So I want you to go out and read it. So I'm going to break it down into some of the key points. Limited review process is gone. Right now, about 40% of the condos out there use this process. It's called a limited review. It's a streamlined process. It's faster. It's usually only maybe 6 pages of questions. And typically, you just got to get the insurance master policy and you can move it down the road. But starting August 3rd, those are done. So that option goes away. Every condo loan will need to go ahead and get a full project review, which means more documentation, more time, more scrutiny, and or there's a second option, which will be a project review waiver. Don't know exactly if that process is changing or if that's going to be a new standard. So project standard updates, expansion of the waiver of project review. They're expanding that to include new establishments with 10 or fewer units. So you might be able to get a project review done that way. And so you're definitely going to want to read that section on the project review. And but the biggest thing that I see is reserve funding requirements are going up from 10% to 15%. So imagine that if your reserve requirements were at 10 and now you have to be at 15 within 6 months, you're going to have to increase those. The only way to do that is to have a condo maybe assessment, special assessment, or to incrementally get that done as quickly as possible. It's going to hit HOA dues pretty hard when it comes to that. Right now, Fannie Mae requires the HOA to set aside 10% of the annual budget for capital reserves. Things like roof replacements, elevators, parking structures, upkeep. That's all going to go up, and it's going to, as of January 4th, it has to have 15%. So you essentially have about a 6-month window here to get your associations knowledgeable on what these new rules are going to be. Otherwise, you're going to have a hard time buying. You're going to have a hard time selling if these things aren't taking place. Now, let's say you're just hypothetically buying next month and these rules are just going into effect. If they only have a 10% allocation of in the reserves now, you should expect that you're going to have to then increase that by 5%. The only way to do that is for your dues to go up. So if the association uses a reserve study, which most of them should, they now have to fund the reserves at the highest recommended level in that study. No more choosing the lowball threshold or the baseline funding options. What does that mean practically? Many HOAs are going to have to raise their monthly dues to hit that 15% target. If you're a condo owner, talk to your board now. If you're a buyer, ask about the reserve funding percentage before you make an offer. It will affect your future dues and the long-term eligibility of the building for conventional financing. Here's the thing, in many cases, no one wants to go list a property and have them go FHA. Usually okay and happy VA if they're approved. It's pretty simple. But now conventional is going to be a lot harder. Number 3, insurance changes. Some relief, but a new deductible cap. So on one hand, Fannie Mae is relaxing some of the requirements. They're no longer requiring that the roofs be insured at full replacement cost under the master policy, and having inflation guard coverage is no longer mandated. That's a bit of relief for the HOA markets where insurance costs have skyrocketed. But this is important. There's a new cap on the master policy, no more than $50,000 deductible per unit. So effective July 1st, some high-rise buildings in storm-prone areas had massive deductibles for the individual units. They will have to bring those deductibles down to that $50K level. Also, unit owners, that means you will, if you own a condo, be expected to carry an HO6 policy that covers the interior and aligns with the master policy's deductibles. If you don't have an HO6 right now, you'll need to get one. Spoiler, if you're in Virginia, Maryland, DC, KSA Insurance, my insurance company, can actually get you that policy. Investor concentration rules are loosening. Again, I'm going to say that for realtors out there and investors. Investor concentration rules are loosening. The old rule capped investor-owned units in established condo projects at 50%. So if they were, there's some places in Arlington that the investor concentration, because of proximity, everyone wanted to buy this because it was close to the Amazon headquarters. They were just buying up these condos and paying cash for them. But once more than 51% of those were investor, you couldn't get conventional financing as an investor in that property and buy another unit. You could buy a unit if you were buying to move in, but you couldn't buy another investment property in there. So now you'll be able to, under conventional rules, that cap is being eliminated. The focus shifts instead on the project financial health, reserves, insurance, and budget, rather than how many units one person may own also. So this could reopen some projects here in Northern Virginia that were ineligible for conventional financing. Freddie Mac also had I'm going to scroll this one, but Freddie Mac had a couple changes. One, if a borrower is starting a new job that begins after closing, saying they signed an offer letter but haven't started the job yet, a probationary or training period on the job no longer is considered a contingency. One of the rules for you to be able to use that income, you couldn't have any contingencies. So they're removing the probationary and training part of that. So that's a positive change for Freddie Mac. So a couple things. Number 3 that I want to talk about, the 10-year Treasury over the last month. If you pay attention to that, we were at 3.95 right before the Iran war. And intraday, we went above 4.3 the other day. We closed at the high market 4.28. And versus yesterday, we dropped 3 basis points. So that was a little bit of positivity. But until we see a little bit of the oil flowing and stability in the Middle East, I would watch the 10-year to see if the 10-year is going to drop any below 4.2. And then and if we can get oil flowing, I'd love to retest that 3.96 range. If that was all to happen, then you would see the Fed futures potentially change to have a rate cut a little bit sooner. But in general, there's a lot of uncertainty when it came to interest rates. I want to stress in this video the changes to the Fannie guidelines for condos. You can only assume that these same guidelines are going to change at Freddie. But more importantly, the cost and time to close a condo are both going to increase. The amount of every time that we, when we apply for condo association documents to be filled out, if they don't fill it out properly, often they will hit us for another fee. Or if we've got to get specific questions answered because they're not answering them and they got to go to the board. But these rules on the budget are going to be huge. And quite frankly, anyone buying a condo right now should be buyer beware. There's no way in most circumstances that this is not going to affect your bottom line on the cost of the next 12 to 24 months of owning a condo until they get that reserve up to that 15% level. So keep that in mind. My name is Kevin Retcher, owner of First Meridian Mortgage. This is the latest episode of The Till. I typically do this video on Thursdays every week. Please do me a favor, like, share, and subscribe. I am a 30-year veteran owned mortgage broker doing business in Virginia, Maryland, D.C. Happy to help you out. I actually have referral partners that I don't get any money from in 32 other states. Happy to give you a referral if that is needed. But just give me a call, 703-799-5626. And this is your latest episode of The Till. Talk to you soon. See you in the next episode.